Imagine standing inside like a massive steel pressure chamber.
Oh, man.
Right. You can literally hear the metal groaning under the strain and the dials. They're spinning dangerously close to the red line.
Yeah, you just know instinctively that something has to give.
Exactly. And, well, it's Saturday, June 6th, 2026, and that pressure chamber is pretty much the exact state of the global economy right now.
It really is.
Because, I mean, if you look at the financial headlines this morning, you are getting this highly fragmented picture. There's a story about military posturing in Iran,
Right.
then a totally separate piece on the strength of the U.S. dollar,
Hmm.
and another headline about yesterday's shocking U.S. jobs report. Oh, and maybe a confusing blurb about gold prices.
They look like completely isolated events.
Right. But our mission for today's analysis is to basically pull back the casing on all of this. We want to show you how every single one of these headlines is actually, a gear turning inside the exact same highly compressed machine.
Yeah, because the danger of consuming financial news in those isolated silos is that you totally miss the underlying mechanics.
You miss the causality.
Exactly. You miss the causality. And by the time we finish today's analysis, that fragmentation should just disappear for you. The geopolitical risk, the labor market, the paralysis at the Federal Reserve, they are entirely dependent on one another right now.
So let's start right at the source of the pressure, which is the geopolitical valve.
Right.
And right now, that valve is the Strait of Hormuz. We don't need to do a whole geography lesson here. You know the stakes of that choke point.
Yeah, everybody knows.
But what's crucial to understand is that the global markets, they aren't waiting for a formal declaration of war. They are reacting violently to the mere threat of supply disruption.
Well, because that threat alone is enough to rewire global commerce overnight. I mean, if you manage a fleet of oil tankers, a credible missile threat means you just cannot operate business as usual.
Right, the maritime insurance premiums for vessels entering that region, they just multiply instantly.
Oh, almost overnight. And some shipping firms just refuse the route entirely, so they're diverting cargo ships around much longer alternative paths.
Which adds weeks to journey times.
Weeks. It burns massive amounts of extra fuel, and it artificially shrinks the available supply of oil hitting the market on any given day. So, the uncertainty itself functions as this massive tax on the global supply chain.
And that tax cascades, right?
Right.
I like to think of it as an economic butterfly effect. A shipping delay in the Persian Gulf doesn't just mean a higher price for crude oil on some exchange screen.
No, it makes diesel more expensive.
Exactly. Which means the trucking company hauling goods across the Midwest raises its rates.
Right.
And it makes the petroleum-based plastics used in packaging more expensive.
It raises the cost of agricultural fertilizers, too.
Yeah. And it eventually bleeds directly into the price of the groceries sitting on the shelf for you and me. But the most fascinating ripple effect here is what this is doing to the bond market, because the current reaction completely breaks the traditional economic playbook.
It shatters the textbook model, honestly. In a standard geopolitical crisis like, let's say a sudden conflict breaks out, you expect a classic flight to safety.
Capital panics.
Right, capital panics, pulls out of risky stocks, and floods into the ultimate safe haven, which is long-term government bonds.
And when everyone buys bonds, the price of those bonds goes up.
Yes, and consequently, the yield, the interest they pay out goes down. Fear goes up, yields go down. That is the historical standard.
But that is absolutely not what we are seeing today. Bond yields are actually climbing.
Yeah, because investors are doing the math on that supply chain tax we just discussed. They recognize that this specific geopolitical crisis is centered on energy.
Which makes it inherently inflationary.
Exactly. If you're an institutional investor, you're looking at the prospect of holding a 10-year government bond, and you realize that rising oil prices are going to keep inflation higher for much longer than expected.
And inflation just eats away at the fixed return of a bond.
Right. So to take on that risk, you demand a higher yield to compensate for the lost purchasing power.
So you have this bizarre environment where geopolitical fear is actually driving bond yields up, not down.
Yeah, because the fear is basically wrapped in an inflation shock.
Which brings that inflation shock directly to U.S. shores, colliding with the May 2026 jobs report that dropped yesterday morning, June 5th.
Oh, what a report.
I mean, Wall Street analysts were universally bracing for a cooling labor market. They predicted roughly 85,000 jobs would be added.
Right.
Instead, the U.S. economy printed 172,000 new jobs.
Insane.
The unemployment rate stayed absolutely flat at 4.3%. Average hourly earnings rose 3.4% over the past year.
Yeah,
Oh, and they revised the previous 2 months upwards by almost 100,000 combined jobs.
it is just a profound display of resilience in the domestic labor market.
Uh-huh.
But as you saw, the reaction from the financial sector was sheer panic.
Okay, wait, let's unpack this for the listener. Because to anyone outside of a Wall Street trading desk, 172,000 Americans getting hired sounds like amazing news.
There does?
People have paychecks, families have security. Why on earth did that headline cause a monetary policy earthquake and make the stock market panic?
Well, the anxiety stems from the relationship between wages, consumer demand, and corporate pricing power.
Okay.
The labor market is adding jobs at that clip, and wages are steadily rising. Consumers feel financially secure.
Right.
And when consumers feel secure, they don't really change their spending habits, even when prices go up.
Ah.
This gives corporations the green light to take all those increased shipping and energy costs we just talked about and pass them directly onto the consumer without losing sales volume.
So the strong consumer basically subsidizes the inflation.
Exactly. It cements the inflation. It turns a temporary price spike into a permanent baseline. But to really understand why this jobs report was so problematic,
Yeah.
you have to look past that headline number of 172,000.
Right, the composition of those jobs.
Yes, look at the actual composition.
Yeah, I looked at the sector breakdown, and this wasn't like an explosion of high-tech manufacturing or software engineering.
Not at all.
The gains were heavily, almost exclusively, concentrated in leisure, hospitality, healthcare, and local government.
Meanwhile, employment and financial activities in high-value corporate services actually shrank.
Right, so that structural imbalance is the core of the problem, right?
It really is.
Hmm.
We are seeing rapid growth in services and the public sector rather than in industries that drive high productivity.
I try to think about it like a busy restaurant. If the owner hires 3 new servers, the restaurant is paying out more in total wages, which puts more spending power into the local economy.
Okay, yeah.
But those 3 extra servers aren't magically creating more food or, innovating a new way to farm vegetables. They're just providing a service.
Right.
So you have more wage money circulating in the economy, chasing the exact same amount of physical goods.
That is a brilliant way to conceptualize the productivity trap. When job growth is skewed heavily toward lower productivity service sectors, you get the inflationary heat of higher wages without the deflationary benefit of producing goods more efficiently.
And it's a really difficult cycle to break.
Very difficult.
And breaking that cycle is supposedly the job of one man, Federal Reserve Chair Kevin Warsh. All of this messy, conflicting data lands squarely on his desk.
Poor guy.
Seriously. I mean, he operates under a dual mandate from Congress: keep prices stable and keep employment maximized.
Right.
In a normal cycle, if inflation is hot and employment is booming, the solution is straightforward, right?
Yep. The Fed raises interest rates to make borrowing more expensive. That slows down business expansion, cools off hiring, and brings prices down.
But applying that standard playbook right now is like trying to fix a software glitch with a hammer.
It really is.
Yeah.
A massive portion of the inflation Americans are feeling is not coming from an overheated, over-leveraged domestic consumer. It is coming from supply disruptions in the Middle East.
Exactly.
Warsh can raise the federal funds rate to 10% if he wants to, but that monetary policy cannot pump a single barrel of oil out of a blockaded region.
No.
It cannot reopen a shipping lane, and it definitely cannot negotiate a ceasefire.
I was reading through our materials for today's analysis, and I kept thinking about this pilot analogy.
I like this one.
Right. Imagine Kevin Warsh is flying a fully loaded commercial jet. He looks down at his instrument panel, and one alarm is flashing red, warning him that the engines are running way too hot.
Which is the inflation from the oil shock.
Exactly.
Yeah.
But the alarm right next to it is also flashing, warning of severe economic turbulence ahead if borrowing costs stay this high.
Yeah.
So if he pulls back on the throttle to cool the engines and stop inflation, he risks losing lift entirely, stalling the plane, and crashing the economy into a deep recession.
It is just the ultimate central banking dilemma. The Fed knows that holding interest rates at these elevated levels is slowly suffocating small businesses and straining regional banks.
Right.
They desperately want to cut rates to relieve that pressure and keep the plane in the air.
But to justify a rate cut, they needed yesterday's jobs report to show weakness.
Exactly. They needed evidence that the labor market was cooling, giving them the cover to say, the economy is slowing down, we can safely lower rates now.
But 172,000 new jobs completely vaporized that excuse.
It slammed the door shut. Warsh is now boxed into a corner. He has no domestic justification to cut rates while inflation is still a severe threat.
Wow.
So he's forced to hold rates higher for longer, maintaining that heavy restrictive pressure on the economy.
Okay, so let's follow the money then. If the Federal Reserve is trapped into keeping interest rates high in the face of a chaotic world, how does global capital react? Where does the money go?
The overwhelming answer is the U.S. dollar.
Because the dollar is essentially functioning as a yielding bunker right now.
A yielding bunker is the perfect description. Put yourself in the shoes of a sovereign wealth fund manager or a major institutional investor operating overseas. You are looking at a map full of geopolitical landmines. You want safety above all else. The U.S. dollar is the global reserve currency. It's backed by the largest military and the deepest, most liquid bond market on the planet.
It's the ultimate safe harbor.
Exactly. But normally, safe harbors don't pay you very much.
Yeah, you usually pay a premium for the privilege of safety.
But right now, because the Fed is trapped into keeping rates elevated, U.S. short-term treasuries are offering incredibly attractive yields.
Oh, wow.
Yeah. So not only do you get to hide your capital behind the thickest steel walls in the global financial system, you're actually being paid a handsome, risk-free return to do it.
So global capital is behaving entirely rationally by flooding into the dollar.
Exactly.
But wait, if the dollar is acting like a giant vacuum, pulling in global capital from all over the world, isn't that catastrophic for the rest of the world? I mean, that mechanism inherently exports severe economic pain to other nations.
It absolutely does. It is a controversial take, but it's true. Currency markets are a zero-sum game. For the U.S. dollar to strengthen so aggressively, other global currencies must weaken against it.
Right.
And the consequences of that are just devastating for countries that rely on imports, particularly energy.
Let's look at Japan as the prime example on the global chessboard here. The Japanese yen has been testing the 160 per dollar zone, which is remarkably weak.
Very weak.
Japan is an industrialized powerhouse, but they have very few natural energy resources. They have to import almost all of their oil and natural gas.
And here is the catch: global commodities are priced and settled in U.S. dollars.
So when the yen collapses against the dollar, the actual price of a barrel of crude oil might not change on the global market.
Well, I mean, it doesn't change, but it now costs Japan significantly more yen to buy that exact same barrel.
Exactly. Without domestic inflation even ticking up on its own, Japan is importing inflation directly through the exchange rate.
Wow.
The cost of running factories goes up, the cost of heating homes goes up, and the Japanese consumer just absorbs the blow. Which puts the Bank of Japan in a horrific position. I mean, do they dramatically hike their own interest rates to defend the value of the yen, knowing that higher rates could crush their fragile domestic growth?
Right.
Or do they keep rates low to support businesses and just watch the currency bleed out and inflation soar?
They are caught between a currency crisis and a domestic recession, and they are not alone in this.
Europe, right.
Yes, the European Central Bank is staring down a similar barrel. Europe's economy is sluggish. The ECB desperately needs to cut rates to stimulate growth.
But if the ECB cuts rates while the U.S. Federal Reserve holds rates high, the euro will plummet against the dollar.
And a plunging euro means Europe's imported energy costs skyrocket again, reigniting the exact inflation crisis they just spent 2 years fighting.
Man. So U.S. monetary policy is effectively dictating the terms of surrender for central banks globally.
That's exactly what's happening.
Okay, but this brings up a glaring omission in how markets usually behave during times of intense fear. I mean, here's where it gets really confusing. We have geopolitical risk skyrocketing. Missiles are flying in the Middle East. We have global currencies under immense pressure. By all historical logic, why isn't gold the ultimate historical safe haven going to the moon right now?
It's a great question. And it breaks the historical gold thesis.
Yeah, it's struggling to gain any meaningful traction.
Well, the thesis breaks on the concept of real yields. Gold has one fatal flaw in this specific macroeconomic climate. It does not produce income.
Right.
It doesn't pay a dividend. It doesn't issue a coupon.
It's just an inert asset, just sits in a vault looking shiny.
Exactly. So to understand why institutions are passing on gold, we have to clearly define real yields versus nominal yields. The nominal yield is just the sticker price on a bond.
Okay.
Let's say a short-term U.S. Treasury pays a nominal yield of 5%. If inflation is running at 3%, your real yield, your actual increase in purchasing power, is 2%. You are making a positive real return.
And you have absolute safety.
Absolute safety, guaranteed by the U.S. government. Now, Contrast that with gold. When inflation is high, but central banks raise interest rates even higher,
Mm.
real yields turn positive. If you are managing billions of dollars, you have to weigh the opportunity cost. Why would you park $1 billion in gold, earning absolute 0%, when you could park it in short-term treasuries, enjoy the same safe haven status, and earn a guaranteed positive real return?
Right. The cost of missing out on those treasury yields is simply too steep.
Exactly. The old market assumption was incredibly binary. War equals buy gold.
Yeah.
But the modern macroeconomic reality requires a more sophisticated formula.
What's the new formula?
The direction of gold right now is determined by this. Geopolitical risk, plus the oil shock, plus the Fed's policy reaction, plus the direction of real yields.
Wow.
Gold loves geopolitical fear, but it is deeply allergic to high real yields. Right now, the gravity of U.S. interest rates is simply overpowering the geopolitical fear.
Okay, so we have built the map of this pressure chamber for you. We have a blocked energy valve in the Middle East, a resilient U.S. labor market pumping out service jobs, a paralyzed Federal Reserve, a wrecking ball U.S. dollar, and an inverted gold market.
That's a lot.
It's a lot. So what does this all mean for where we go from here? Where does the pressure release? Because a system this compressed cannot stay static forever.
No, it can't. And if we synthesize the data from our sources, there are three distinct paths forward for the global economy.
Let's start with the most optimistic route.
Okay, path one is ceasefire progress. This is the cleanest path. If diplomatic channels somehow succeed and the credible threat to the Strait of Hormuz is lifted, the pressure valve opens.
Right.
Shipping routes normalize, insurance premiums drop, and the artificial tax on the global supply chain just vanishes. Oil prices would fall significantly.
And that drop in energy costs would filter through the economy, cooling off inflation data.
Exactly.
And that finally gives Kevin Warsh his excuse.
Yes. With inflation cooling, the Fed can safely cut interest rates without fear of resurgence. As U.S. yields drop, the dollar weakens, relieving the imported inflation pressure on Japan, Europe, and emerging markets. The global economy basically avoids a recession and slowly normalizes.
That is definitely the ideal outcome. What is the dangerous worst-case scenario?
Path two is escalation. This is the stagflation nightmare.
Oh, boy.
Yeah. If diplomatic efforts collapse and the Middle East conflict dramatically widens, oil prices won't just stay elevated, they will spike violently. Inflation expectations will become entirely unmoored.
Right.
The Fed will be backed into a corner where they might not just have to hold rates, but actively raise them again into an already slowing economy.
Which sends the dollar into the stratosphere.
Oh, a violent spike in the dollar would decimate weaker global currencies, sparking sovereign debt crises in emerging markets. Domestically, the combination of extreme energy costs and punishingly high interest rates would break the consumer.
You get stagnant negative growth combined with runaway prices.
Yep. The system bends until something fundamentally snaps.
Stagflation really is the ultimate trap. What's the third path?
Path three is frozen limbo. Honestly, this is the most insidious scenario and statistically often the most likely.
Just rolling uncertainty.
Exactly. We don't get a grand diplomatic resolution, but we don't get a system-breaking escalation either. We just get rolling, persistent uncertainty. The threat in the Red Sea remains.
Yeah.
Oil stays uncomfortably high, but range-bound.
Right.
The U.S. dollar stays strong enough to cause global pain, but not quite strong enough to trigger immediate collapses.
And the Fed stays frozen.
The Fed does nothing. They wait for data that never gives them a clear signal. In this scenario, there's no dramatic crash. It is just an exhausting grind.
Consumers slowly deplete their savings trying to keep up with sticky inflation.
Yeah. And businesses pause long-term investments because the geopolitical landscape is too muddy, and global growth just steadily erodes over years.
It's an economic war of attrition.
It demands an incredible amount of endurance from both investors and everyday consumers.
If there is one overarching takeaway to synthesize from today's analysis, one concept to fundamentally change how you view the financial news, it is this. When you pull up a market dashboard and look at the DXY, the US dollar index, which measures the dollar against a basket of foreign currencies, and you see it hovering around 99, you are no longer just looking at a currency quote.
No, you're not.
You are looking at the master pressure gauge for the entire global system. It's the real-time scorecard of the trapped Fed, the resilient jobs market, and the geopolitical fear all colliding into one number.
The interconnectedness is absolute. You cannot trade the jobs report without understanding the shipping lanes in the Middle East.
Right.
And you cannot understand the Bank of Japan's struggles without understanding U.S. domestic service sector wage growth.
So we turn the question over to you. Looking at the mechanics of this pressure chamber we've outlined today, which path do you think the global economy will take? Are we inching toward the relief of ceasefire progress?
Are we ignoring the warning signs of escalation?
Or are we already trapped in that grinding, exhausting, frozen limbo?
And as you weigh those three scenarios, consider the long-term fallout of this current dynamic. We have seen today how the U.S. dollar strength exports severe economic pain to Japan, Europe, and emerging markets.
Yeah.
If this pressure chamber dynamic persists and the rest of the world continues to absorb punishing import inflation just because the U.S. central bank is fighting its own domestic battles, will the sheer pain of imported inflation eventually force global economies to band together?
Wow.
Will they try to engineer a new trade system that bypasses the U.S. dollar entirely?
A tectonic shift in the global financial order born entirely out of necessity. That is a massive, lingering question to ponder long after the audio stops today. Thank you for joining us for today's analysis. We hope this gave you the tools to see the machinery operating beneath tomorrow's headlines. Until next time, stay sharp and keep questioning the narrative.